ags are in everything, because if it doesn't rain in Kansas, no one in New York City skips their bagel in the morning. They're still going to use that wheat.
You can take advantage of all these different areas of grains, blend them together, and now you get a risk-adjusted return benefit that you really can't find anywhere else.
That's Sal Gilbertie, CEO and founder of Teucrium, and Grant Engelbart, Senior Portfolio Manager at Brinker Capital. We thank Teucrium for sponsoring the live ETF Think Tank Exchange, as well as this podcast.
We're making the case for ag in the face of climate change. I'm Dan Weiskopf.
And I'm Kedar Wilson. Welcome to the Think Tank Exchange podcast. Hello, Dan. How's the ETF professor doing today?
I'm doing great. Before we get into the podcast, I'll remind listeners to join the live ETF Think Tank Exchange so that you can earn CE credits while learning from our experts as they exchange thoughts and ideas.
Our goal in both the live show and this podcast is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
That's because our value proposition is to enhance yours. And so in this episode, our own Dave Armstrong and Michael Gaia learn how to navigate global ag markets in the face of climate change.
Then Dan and I will return with ideas that can make a difference. But let's get on with the show.
Yes, on to the highlights.
Sal, let's start out with the big picture. Can you talk a little bit about the agricultural markets and how you see them in ways that we as regular investors don't?
Sure. Ags are in everything. So I think when we ask an investor, do you have anything besides stocks and bonds in your portfolio? Many say, yes, I have commodities. Oh, really? What do you have? Well, I have gold and I have oil. All right, gold's its own little thing. But oil, why do you have oil? Well, it's everywhere. I drove to work. I know that the stuff got to my grocery store because a truck used fuel to get there, and I adjust my thermostat in my house. But they don't understand that literally everything they touch probably has grains in it. And we use a quick example of corn in a service station. So if you pull up in America to fill the average SUV with gasoline, you're using about a bushel of corn to do that. And that's corn's number 2 global use is in ethanol, which is in the fuel mix. Its number 1 use is to feed animals. And so, in fact, virtually all grains, except for wheat, number 1 use is to feed animals. And so what you've got is, if your kids jump out and buy those beef jerky sticks, or you get some chicken nuggets or something, you are consuming grain. If you grab anything sweet out of a cooler, it likely has corn syrup in it. That's corn's number 3 use. If you're taking notes right now, listening to us, the paper is held together with cornstarch. Corn's number 4 use. Corn is everywhere. It's not possible to not use it. Soybeans are the same way. You've got biodiesel comes from soy. We eat soy in a lot of ways, directly through soybeans and tofu, and indirectly through the meats that we eat. Wheat is the number 1 in terms of consumed grain by humans besides rice. So rice and wheat, they're consumed directly by humans more than anything, but wheat is used in feed, so it's integrated. And sugar. It's everywhere. So you've got the big 4 ags, and they're not correlated because with the S&P 500. I mean, they're low correlated. Everything correlates, but they're very low correlations compared to gold. They're minuscule correlations. Gold has a much higher correlation. So does oil to the S&P 500 and grains, because if it doesn't rain in Kansas, no one in New York City skips their bagel in the morning. They're still going to use that wheat.
Speak briefly, if you would, to the notion that you had mentioned before, the global interconnectedness of the markets. The number of suppliers of agriculture products to the world, I think, was surprisingly small. Can you comment on that briefly?
I think it's the smallest in soybeans. And so soybeans are grown around the world in many countries. They're consumed and used in many countries, but there are really only 3 countries that export soybeans, that grow enough to export. In order, they're Brazil, the United States, and Argentina. And so last year, for instance, the Chinese had a crop failure. They literally came out buying all kinds of corn and soybeans and wheat, but they bought all of the soybeans the world's number 1 global exporter, Brazil, had to export. They then turned to the number 2 global exporter, the United States, and literally bought as many soybeans as they could from us. That's why we're down from a normal 30 to 40-day supply to an under 10-day supply, 9.6 days. That's the reason. So there are only a few countries that can grow enough that have surplus that then you can export. And so if there's a problem in one of those growing areas, it results in a supply disruption. The demand stays steady. You get higher prices. That's what we're experiencing now globally.
Yeah. So Sal, let's play off of that point about the supply disruption, because commodities, I think, are unique, and agriculture in particular is unique in the sense that they're these sort of, there's a kurtosis to it, right? Meaning that you can get these spikes in price because of the supply disruptions you just referenced. How quickly can some of these ag producers respond to that, right? In terms of trying to turn on, obviously there's growing and everything, there's a lead time there, right? But talk us through sort of the historical response by some of these producers when they have these disruptions like what we saw with COVID.
Sure, it's 1 to 2 years. So it's a growing season. So, it's basically you plant seeds in the spring. Just think about it. You plant seeds in the spring. And we're not talking about lettuce where you can grow it, in an abandoned building in an inner city under artificial light, and you can feed the local area. We're talking about massive quantities of corn, soybeans, and wheat that are grown on literally hundreds of millions of acres around the world. You have to rely on the cosmic weather cycles, spring, summer, autumn. That's how it works. So, compared to, say, a copper mine or compared to developing an oil field, grains are very fast. All right. But you can't just flip a switch and get them on. You've got to wait for the next growing season. And that's actually where we stand right now. Because China had a crop failure last year and bought basically all of the crops around the world that they could. And remember, about half of everything is grown in the southern hemisphere because of Brazil and Argentina. And about half is grown in the northern hemisphere because of everywhere else. It's a little northern. It's about 2/3, 1/3 actually. But in essence, you now have to wait for the growing season. So we are in very low supplies. Counting this season, meaning the seeds that are going into the ground just now. So the plants are, this high around the northern hemisphere. Those have to mature and be harvested. And counting on a good harvest, that's the 10-day soybean supply that we're counting on, literally. So we need another year. We need till a year from now, when we're all speaking, to see how the world's doing on inventory. It'll probably still be tight, and what the projections are for the land area. Now, to answer your question, what happens is every farmer in the world is going to find some land to plant corn. When they're used to $3.50 corn in the U.S. and it's trading at closer to $6 a bushel, they're going to find that land. Whatever land they have that's fallow, they're going to plant. So they do respond, but it takes a year or two. And when you draw down inventories globally, like we've done, it takes 2 years. So it will take this season and next season, assuming good weather, to loosen things up from here.
So Grant, I want to bring you in next here, because I don't know if too many advisors think in terms of weather cycles and seasonality in that sense. Talk us through how historically you've looked at agriculture. And, what are some of the things that make you want to consider buying into it for client portfolios?
Sure. Yeah. It's a great question. I think, one of the reasons that advisors historically don't use commodities, I guess kind of getting into that, is that education gap you mentioned. The drivers of commodity prices are very different than the prices of stocks. And that's an opportunity, right? It's weather cycles, it's supply and demand driven. More so than other areas. It's also a whole other set of language, right? So I think the education aspect of it is important, and Sal and team have done a great job of ramping that up and kind of helping drive that for the agricultural space. Standalone volatility in commodities is higher, not necessarily all commodities, but natural gas is kind of the poster child for that. But that diversification benefit, it comes back to that low correlation. Bringing that into play, that standalone volatility can be beneficial. But I think rebalancing is really important. So rebalancing portfolios, rebalancing a portfolio of commodities is important to take advantage of that volatility, so that when you get these spikes, when you get that kurtosis that you're referring to, you take advantage of it and you kind of level set and you get back and you reallocate to the commodities that haven't done as well. And we see that in the ag space quite a bit. I'll also add, just when we think about commodities and when we see advisors that don't want to use commodities, it's just a return factor, right? It's growth stocks have led the way for however long. And there's not a use for it. And there's people who have gotten burned on oil and gold in the past, and it's much more than oil and gold. And so we think about using commodities in a much broader way. That further emphasizes that rebalancing effect. When you have ags and you have a more equal approach, you're not reliant on the price of oil. It's not a GSCI based kind of index. You can take advantage of all these different areas of grains, the other areas of the agriculture market, which are robust, and these different commodity prices blend them together. And now you get a risk adjusted return benefit that you really can't find anywhere else.
Yeah, let me go to you, because I'm curious to hear sort of your thoughts on how advisors question sort of the longer term merits of an agriculture allocation, right? Because it's not exactly a buy and hold type of investment, right? There's cycles, but for the most part, prices on average stay kind of fairly tight, I think. So how do you kind of get advisors to understand the benefits of it? Grant referenced some of it in terms of the diversification benefits, but I'm thinking more in terms of the longer term secular cycles that you live in.
Well, what we try to do is explain to people the fundamental factor that agriculture is a subsidized category. Governments subsidize agriculture around the world. So the very best time to look at agriculture is when it's at its most boring, when those prices are flatlined. I mean, we saw corn prices flatline for the last 6 years, literally. We've seen, and it just sits there because the producers are responding to the increased demand, and they're growing more. And global warming actually helped that. So a warmer climate, corn is a grass. It loves heat and moisture. And a warmer climate gets more moist air, more rain in the northern hemisphere. We literally have had record crops. You've had corn flatlining for 6 years, but that's the time to look at it when it's boring and quiet, because it won't go below a certain level. Farmers will just stop planting it. So at that time, your risk, the downside is limited historically when you look back, and your upside is really extraordinary because people don't stop using it. But if it does stop raining, you have these explosions of price of the upside. We've seen in the last, I think it's 13 years, corn double in price. And so, we've got a lot of people who call us and say, I just put 0.5% or 1% of my portfolio into your corn fund. And they understand because they look back at that chart, they're going to hold it and it's going to explode. And that's, they're going to see corn in the headlines. They're going to see at the rebalancing time, as Grant pointed out, that, whoa, what happened to this? And they're going to rebalance or get out. I mean, that's what we see. I think that, the advisors who really believe it's a buy and hold, they don't belong in agriculture. Agriculture is not a buy and hold. We call it wait, drought out. So wait, WEIGHT, wait for the drought. When prices double, get out because every farmer is going to plant. And so get out or rebalance to Grant's point. So that's how you have to look at it. You can't just go to sleep with this or probably any investment.
Yeah, Grant, let me go to you for a second. So you talked about rebalance a little bit earlier, and I want to kind of get into a discussion around active management within the ag space, because rebalancing requires a degree of momentum for it to work, right, up and down. How do you think about active allocation in agriculture? Meaning, among the available options in the ag space, is it a function of just simply looking at what's advancing the fastest, or looking at fundamentals? How do you kind of think about that interaction with that rebalancing decision?
Yeah, it's a great question. I mean, I think at a naive level, you could let's say equal weight all sales funds and then just rebalance them on a frequent basis. Would be one way to look at it. But I think fundamentals are important. But Sal mentioned that lead time on fundamentals would be in a couple of years, and so I think that's going to continue to drive prices. But momentum definitely drives prices, or is definitely a factor to look at. And you want to wait for, as we've actually seen lately in a few commodities, things to roll over a bit, kind of to make that rebalance. We look at sentiment a lot, usually measured by commitment of traders positioning. So, speculative longs or shorts, or hedgers long and short in the areas in various commodities, just to see how stretched the position is, and use that as a guide as well. If that gets extreme, that would be a good time to rebalance, right? If it gets extreme long in one commodity, rebalance that back. So we think sentiment and trend are very good short-term drivers of thinking about the space, with the long-term fundamental driver or longer-term fundamental driver to make those changes.
Yeah, Sal, let me go to you on this now. So one of our colleagues calls himself the professor, Mr. Dan Weiskopf, and he always says that structure matters, and we joke with him about what exactly that means. But put your professor hat on, kind of educate us a little bit on structure when it comes to commodity ETFs, when it comes to ag ETFs. Talk about futures, talk about contango, without getting too deep in the weeds, but give us some sense of sort of how it works from an investment case perspective.
Sure. Well, I think that there are two different types of structure inside of commodity ETFs. One is mostly single commodities, and we're all familiar with the energy-based ones, where they hold in essence the front month or the front several contracts because they want to capture those spot movements. That's a short-term holding. That's a trading ETF. That's one if your time horizon is 6 hours to 6 weeks. Those are great ETFs to use. They're highly liquid. They'll move and respond with the spot markets. Our ETFs are designed a little bit differently. We're the only single commodity ag ETFs out there. And so, people use them for both trading and investing, but we design them for investors. We design these things because we hold the curve. We hold second month and third month futures. So futures trade a variety of months, what they call it out the curve, so into the future. And it's basically the market's greatest minds trying to determine what the price of that particular commodity will be at a particular time in the future. And they go by months. Well, in say for corn, you only have 5 contract months a year listed. So you've got March, May, July, September, and December. We only hold the second month, the third month, and then the December following third month. So if second month is December, we'll be in the following December. You'll be holding corn out sometimes almost 2 years out the curve. And that's where you want to be if you're putting a commodity in your portfolio for diversification purposes, where you want to hold it. You want to be out the curve, where the only people trading that are the greatest minds that need to trade it. Hedgers, suppliers, end users. There's some speculators out there, but you really want to be where the trade money is. The experts in that particular commodity are the ones trading further out the curve. We hold those contracts. So we're not designed to track spot. We're designed to track the futures that we hold, which again are second month, third month, and an anchor month. It's different per commodities. And what that will do is reduce the volatility versus spot. So you'll see a spot month commodity bouncing around. Our funds, because they hold the curve, will not go up as fast and they will not go down as fast, but they will shift higher or lower with the particular trend in that commodity. And that's the point. That's what you want in your portfolio as you allocate.
Grant, you want that as a portfolio manager? Is that a benefit or not?
Absolutely. It's structure in commodity ETFs matters significantly. I mean, if front month oil futures going negative last year wasn't any indication of that in extreme form. So yeah, knowing what the ETF is going to do, how quickly it's going to rebalance, where it's going to move on the curve, and the structure of that from a contango or backwardation standpoint is very important. I know liquidity comes into play as well, as Sal mentioned, with various contracts. And all of these, these play into other features of the commodity as well, or the ETF as well, whether it's the liquidity and the ability of market makers to hedge the product. It's all interwoven in that aspect. So structure definitely matters. Agree with the professor.
Sal, the elephant in the room is the weather that we're going through, right? Lots of discussion about rising temperatures, changing weather patterns, regions being affected disproportionately, some better, some worse. I don't think that there's any catalyst that is more important to consider with respect to a market than climate change. How do you think about that, and where do you see this going from here?
We think about it all the time, and with the variability in weather, where we've moved from the dialogue being global warming to climate change for a reason. Global warming, came, but now we've got a variability in climates around the world. So you get a lot of rain in North America, you get a lot of grain, you get dryness in, say, right now, Brazil. Southern Brazil is a good story. Brazil's the world's #1 soybean producer and exporter. They're the #2 corn exporter, soon to be #1. They're literally going to overtake the United States. They're on their way. And because their soybeans were planted late because there was too much rain, in Brazil's equatorial, so they plant soybeans, they harvest the soybeans, then they plant corn. So they actually get 2 crops in a season. That doesn't happen here in the US. You plant either corn or soybeans. Basically, Brazilian soybean crop was planted late because of too much rain. That means the Brazilian corn crop is going to be planted late. And the Brazilian corn crop got planted during dryness. And normally, just to give an example, Brazil was expected to harvest 109 million metric tons of corn. Now the estimates are closer to 90. That's a 17% drop in corn production in Brazil. They're the world's #2 corn exporter. Corn prices are going higher. That's just how it works. It's supply demand. And that's where weather is a factor. Too wet in China last year, too dry in Brazil this year, very warm in the United States the last 8 years, which gave us perfect crops for 8 years. We got a decline from the last price spike. It took 2 years to get prices to normalize, where we replenished our supplies in the United States again of grains, we went 6 years at break even. Now suddenly we're 50% off of those levels, more than that. And we're still wondering about the weather. So weather is literally everything when it comes to agriculture.
How do farmers counteract some of these weather volatility dynamics you talked about?
Well, through seed genetics, through John Deere tractors. They used to go 3 miles an hour and just plant seeds with an archaic planter that was 100 years old technology. Now they go 8 to 10 miles an hour. They can adjust both the fertilizer, the seed depth every 3 feet as they're going 10 miles an hour. So a farmer needs a very narrow, proper weather window to plant all of his fields, where he used to need a really wide window. So the technology in both seed technology and genetics of the plants that improves the production, and the farmers are flying drones over their fields now to see where the problems are. So the technological advances have literally allowed, thank God, the production to keep up with the demand. When you look at demand charts, and people can see them on our website, of the combined soybeans, wheat, and corn that I mentioned earlier in this broadcast, we're talking about a steep upslope in demand. Production needed to keep up, and it was technologic. That's it.
Sal, I love it when our guests can see things that most of us cannot. Thanks.
That was a very interesting episode, Dan, and let's get to some ideas that will really make a difference.
Yeah, a couple of highlights that resonated with me on a broad scale. I loved how Sal made it very clear: ags are everywhere.
Absolutely. I mean, his point when he talked about, just in America overall, and if you're driving an SUV with gasoline, you have a certain bristle of corn that's in it. And corn is really everywhere, right? These are things you really don't think about when looking at commodities. You kind of isolate it and say, well, this is gold, this is corn, et cetera. But the things we use on an everyday basis on a global scale, these particular products are in there. These commodities are in there.
As he put it, if it doesn't rain in Kansas, somebody still wants their bagels in New York.
Yes, absolutely. What really struck me as well is Michael Guyot's questions in regards to how advisors look at, weathers and cycles and seasonality. That was something that really stood out to me. And Grant's response to that was phenomenal, where it was really a matter of education and looking at it from that perspective, and how Sal and team at Teucrium really breaks that down for more of a better understanding.
Yeah, Grant's a very experienced ETF strategist, and I also thought how he highlighted how structure matters and how all the contracts are set up really is important, and how these solutions need to be thought through before they're used.
Absolutely. One thing that really stood out as well is him mentioning what are some of the drivers of commodity prices and how it's really different when it comes to stocks, right? And the pricing of stocks and its volatility, and looking at weather and seasonality. That really stood out to me as well.
And my other point would be about climate change. Everybody's very concerned about climate change, and they had some great points about climate change.
Mm-hmm.
And at the end of the day, these are long cycles, and climate change is something to be considered.
Absolutely. I mean, I try to watch the news on a nightly basis, and you hear of the changes and weather changes and patterns that happen across the U.S. alone and just globally. And I can only imagine how those things affect commodity prices, and how innovation is really important when it comes to tracking commodities and the pricing effects that can occur due to climate change.
And, in the days when everybody's concerned about inflation, commodities have to be something that they consider in the way of their asset allocation.
Yeah, no, absolutely.
Well, in the spirit of giving, Grant shares a few charities that you might wish to support.
Yeah, thanks. It's great you guys do this. And of course, I can't just choose one, but we work closely as a firm with Teammates Mentoring in Nebraska. So actually, Coach Tom Osborne from Nebraska Cornhuskers works closely with them as well, kind of pairing mentors with young kids. I think it's fantastic. We also give a lot to an open door mission, which is generally focused on homeless folks in the area. And then, nationally, I think the Leukemia and Lymphoma Society is, amongst other kind of cancer-based charities, is definitely a fantastic way to donate.
Brant, those are great contributions. Also, it makes sense that you picked several nonprofits. As a portfolio manager, you're always picking from several different options. So,
right, diversification.
Exactly.
As we wrap up, we'd like to thank Sal Gilbertie and Grant Engelbart for their thoughts and insights. And again, we thank Teucrium for sponsoring both the live ETF Think Tank Exchange and this podcast.
You can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
Until next time, keep the exchange going with our clients. I'm Dan Weiskopf.
And I'm Kedar Wilson. Take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such. Teucrium Global Marketing Disclosure. Read the prospectus carefully before investing. A copy of the prospectus may be obtained at teucrium.com. The expressed views were those of Teucrium Trading LLC as of June 8, 2021, and may not reflect the views of Teucrium on the date the material was first published or any time thereafter. These views are intended to assist in understanding certain factors that may contribute to the price of agricultural commodities or commodity futures such as corn, wheat, soybean, and sugarcane. In no way do the views expressed constitute investment advice, and this document should not be considered as an offer to sell or a solicitation of an offer to buy securities outside of the United States of America. Any decision to purchase or sell as a result of any information or opinions expressed in this communication will be the full responsibility of the person authorizing such transaction. An investor should consider investment objectives, risks, charges, and expenses carefully before investing. The prospectus contains this and other information. The Teucrium corn, sugar, soybean, wheat, and agricultural funds, the funds, are not mutual funds or any other type of investment company within the meaning of the Investment Company Act of 1940, as amended, and are not subject to regulation thereunder. The funds are commodity pools. Investors may choose to use the funds as a vehicle to hedge against the risk of loss, and there are risks involved in such hedging activities. Unlike mutual funds, the funds generally will not distribute dividends to its shareholders. Investors may choose to use the funds as a means of investing indirectly in corn, soybean, wheat, or sugarcane. There are risks involved in such investments. Shares of the funds are not FDIC insured, may lose value, and have no bank guarantee. The funds invest in corresponding commodity futures contracts, cash and cash equivalents, and are not intended to directly track the spot price of a particular commodity, such as corn, wheat, soybeans, or sugarcane. Futures risk. Commodities and futures generally are volatile and not suitable for all investors. Futures investing is highly speculative and involves a high degree of risk. An investor may lose all or substantially all of an investment. Investing in commodity interests subject each fund to the risks of its related industry. These risks could result in large fluctuations in the price of a particular fund's respective shares. Funds that focus on a single sector generally experience greater volatility. For further discussion of these and additional risks associated with an investment in the funds, please read the respective fund prospectus before investing. Futures may be affected by backwardation, a market condition in which a futures price is lower in the distant delivery months than in the near delivery months. As a result, the fund may benefit because it would be selling more expensive contracts and buying less expensive ones on an ongoing basis. And contango, a condition in which distant delivery prices for futures exceeds spot prices, often due to costs of storage and insuring the underlying commodity. Opposite of backwardation. As a result, the fund's total return may be lower than might otherwise be the case because it would be selling less expensive contracts and buying more expensive ones. Past performance is not necessarily indicative of future results. Diversification does not ensure a profit or protect against loss. Foresight Fund Services, LLC is the distributor for the Teucrium funds. This material must be preceded or accompanied by a prospectus.